One of the great things about being a retiree is the freedom that you have. Specifically, the freedom of income and thereby the taxes that you actually pay. But what if I told you that in retirement, there's actually 5 different tax brackets that you need to navigate through? Yep, that's right, 5. And today, we're going to help unpack them for you. Hello. If we haven't met before, I'm Planner Mike, a certified financial planner and owner of True Wealth Financial. This is a show that's dedicated to helping Christians retire with confidence and clarity so they can finish their race with purpose. Thank you so much for tuning in. Today, I want to discuss the 5 different tax brackets a retiree might find themselves in. And I want to show you a couple of visuals to help you understand it along the way. And hopefully towards the end, you'll have a better understanding of how your retirement taxes actually work. And of course, we'll close with one micro action to help you get one step closer to a Christian retirement that is prosperous, enjoyable, and purposeful. Let's jump in. Bracket number 1 is ordinary income. And this is what most people think of when they think of taxes, right? So this is your federal income taxes, not including state. And we can see here it goes from essentially 10% up to 37%. So this is taxable income. This is the money you pay on taxable income. So if we go to a 1040 real quick, so we can see on line 9 is your total income. That total income is then adjusted by some things that are deducted, like half of your health insurance if you're self-employed or student loan interest, things like that, which gets us then to adjusted gross income. That is what's referred to the line. There's things above the line and then things below the line. From there, then we can deduct either standard or itemized deductions, QBI, if you are a self-employed person, which then brings us to taxable income. So this is what you pay the marginal ordinary income tax rates on. And you can see here it varies. So these are the rates based upon a family. So $23,850. This is married filing jointly. The single ones are about half of. So everything I'm going to show you today is from a married perspective. I will show you towards the end the individual ones, but I'm not going to go through all of them. It's the same concept at that point. But we have a progressive tax rate, which means you don't pay, like if you're making $225,000, for example, you don't pay 22% on everything. You pay 10% on the first 23,000, you pay 12% on the next 96, right? And then so on and so forth, right? So it's a progressive through there. And again, these are the married rates. The single ones are about half the difference. But that essentially is bracket number 1, ordinary income. That's how most things are taxed. But of course, that's not where it ends, right? The next thing to consider is that of capital gains. So capital gains is the idea that you bought a capital asset and that you sold it for more than you bought it for. So for example, you bought a stock, that stock costs $100. You sell it sometime later for $150. The gain that you made on that capital asset, $50,000 in this case, that is what is taxed upon. So you can generally think of investments like stocks, bonds, or mutual funds, but it also could be property or other assets. There's 2 flavors of capital gains, long-term and short-term. Short-term will be taxed like ordinary income, like those normal and ordinary income brackets. Long-term capital gains, though, as seen here in the light pink purple, is that of long-term capital gains. So long-term capital gains are assets that we bought and then we held and it went up for at least a year and a day. That's long-term. And if things are long-term capital gains, then we don't tax it ordinary income. We tax it these lower rates here. These same rates apply to qualified dividends. So qualified dividends is a special category of dividends that receive favorable tax treatment, right? And the idea is that they have lower rates than the ordinary income ones, right? So there's 2 conditions you have to apply. The dividend has to come from a domestic or qualified foreign corporation. So most U.S. companies will do this. And then there's a holding period of at least 60 days before or after the ex-dividend date. So the ex-dividend date is the idea that a stock trades without the dividend. right? So you have to hold it generally for, about 121 days, right? 60 days before the date and then 160 and then 60 days after. And the idea there is that you're not just buying something, get the dividend, and then, get a discounted tax rate, and then you sell it the next day. So they make you hold it for, almost 4 months or so in order to get qualified rates. So again, looking at our chart here, again, these are the merit rates. They're up to $96,000 of income is tax-free, right? So that's really, really nice. Now, of course, this is stacked on top of income, right? So you have your income, ordinary income, and then it's stacked on top of that. But if all you have is dividends or qualified interest from these investments, right, you can get $98,000 tax-free. That's a pretty nice way for a retiree to get some tax-free income, okay? But the challenge here is that, these rates, while they are favorable, they get intertwined, right? So you have ordinary income in most cases, like IRAs and 401ks, stuff like that. And then you get qualified dividends or long-term gains, and they actually get intertwined in between as shown here. So you're trying to navigate between not just one tax bracket, but really two. But of course, it doesn't stop there. We have more than just two tax brackets. We actually have 5 that we're going to kind of walk through. So the next one is Social Security. So Social Security is based upon not taxable income and not qualified dividends, but in this case, it is based upon provisional income. So as a reminder, we did a whole show on how Social Security is taxed, but your provisional income is your AGI, showed you on a tax form, plus half of your Social Security benefits, plus whatever tax-exempt interest that you have as well, generally municipal bonds. So that provisional income will dictate what percent of your Social Security benefits are taxed. And again, we did a whole show on this. We'll put a link to that episode in the description below. But if that provisional income is less than $32,000, matter of fact, jointly, you don't pay any tax on your Social Security benefits. Between $32,000 and $44,000, you pay somewhere between 50 and 85%. It's a sliding scale. And then anything above 44, then you'll pay 85% of your benefits is taxed. Now, the sad thing here is that these numbers, 32,000 and 44,000, those were set in 1983. That's over 40 years ago. And the important thing about those thresholds is they've never been indexed or never been changed for wage growth since the beginning, which means every year more and more people are paying tax on their benefits. Now, the One Big Beautiful Bill incorporated something called a bonus senior deduction that over the next 4 years will help a little bit. But of course, just like above, those rates are not independent of themselves. They get intermingled with ordinary income and long-term capital gains or qualified dividends as well. The next bracket that a retiree needs to concern themselves with is that of IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amounts. This is essentially the amount of extra you get to pay for Part B and Part D premiums of Medicare. So notice that this here, the type of income, it's not earned income, it's not taxable income, it's MAGI. MAGI stands for Modified Adjusted Gross Income. And you will not find this anywhere on the tax forms. So I have another guide for you that I'm going to show you here that shows you all the different MAGIs for different things. So different things in the tax code use different modified adjusted gross incomes, and it's not consistent. Why would it be, right? We try to make taxes as confusing as possible. So jumping to that guide, I'll show you what IRMAA consists of from a MAGI perspective. So you can see here on this AGI Modified Adjusted Gross Income Summary Guide that for IRMAA essentially is your adjusted gross income plus, in this case, tax-exempt interest. And that's it. Right? So this guide here breaks down all the different modified adjusted gross incomes. I'm going to show you at the end how you can get a copy of this guide. But a couple things about IRMAA. The first thing to remember is, and we're only going to really look at Part B premiums. There's other ones for Part D, but they get nuanced and a little more complicated, right? So if you're not super familiar with Medicare yet, there's Part A. It's quite the alphabet soup of its own. Part A is the idea of hospital insurance, major medical, if you will. Part B is kind of like doctors, labs, outpatient type of stuff. There's a Part C, which stands for Advantage plan, which is A plus B plus dental plus vision and things like that, provided by more traditional companies. Aetna, U.S. Healthcare, Blue Cross, Blue Shield, things like that. And then Part D is for drugs or prescription drugs, right? And so you pay, A is what's free. A, essentially, you paid in all your life in for A, and you get that, and it is free, although it has co-shares and deductibles and things like that. But B and D, you pay for even as a retiree. Well, everyone gets to pay a flat premium this year. It's $185,000 per person. But if your income goes above certain limits, you get the privilege of paying more for your health insurance. So, for example, if your modified adjusted gross income is over $212,000 as a married couple, and again, there's another ones for singles that I'll show you at the end, you pay an additional $74 for Part B. And remember, this is per month per person, meaning husband and wife. Here's the other challenging piece of it is that it's not from income this year. It's from income from essentially 2 years ago. So why is that? Well, if you think about it, in 2025, back in the spring, March, April, you did your 2024 taxes. So the IRS got that information. Well, your Medicare premiums for 2025 already started in January. You already had those amounts started coming out. So in order for our 2026 premiums, they can't use 2025 because they're not going to get those numbers from your taxes until 2026. So they use your 2024 taxes that you filed in 2025 to set your 2026 IRMAA rates. So there's what's called a 2-year look back. So these rates here, as seen in this kind of orangish peach color, essentially is 2023's incomes for 2025 IRMAAs. And so you can see it gets pretty drastic, right? If you're making over as a couple 266, you pay double what a single person, what a non-IRMAA paying person pays, right? They pay 185, you pay 185 plus 185, and so you're paying double for that. And it's not like you get better services. You're not getting additional services or discounts or whatever. The same deductibles, same copays, the same services apply regardless of the premium that you pay. But of course, like all the other incomes we've already looked at, this too gets intertwined with all these other rates. So you can see it starts to get very confusing as to which thing, imagine your income as a vertical line through those things, but it's all different. Some is taxable income, some's provisional income, some's taxable, some's now MAGI. And of course, we're going to see a couple more. Which brings us to bracket number 5. Bracket number 5 is referred to as NIT or NIIT, Net Investment Income Tax. This is the idea that you get to pay extra tax for income on investments over $250,000, right? So again, it's all stacked. It's not like I don't have, if you make $250,000 in wages or in other things, and now you have even a little bit of investments from income from investments on top of that, you pay extra on that portion, right? So this is things like interest, dividends, rental income would count as this. So it's not based upon earned wages, it's based upon your AGI. So it's an AGI threshold, $250,000. So if your AGI as a married filing couple and you're making income on investments, you pay an additional 3.8% tax on that investment income. This was part of the Affordable Care Act that went into kind of paying for the subsidized insurance that other people got. But of course, like all the other ones, these get all intertwined together with everything else. And I said I'm going to do 5, but I'm actually going to do one bonus bracket here as well. And that's the idea of FICA. Right. So FICA stands for the Federal Insurance Contributions Act taxes, or essentially payroll taxes. This is the amount of money that you're paying for Social Security and Medicare. You say, Mike, as a retiree, I might not pay this. Most times you will not. But if one's retired and one spouse is still working, you still have that. And if you get a part-time job, it's not like even if you're receiving Social Security or on Medicare, if you still get a part-time job doing something, you still pay into those. So those are still happening as well. And if you're self-employed, right, you do some consulting or independent contracting or whatever, you don't pay just one side, you get to pay both sides, the employee and the employer, right? So just to understand how those are, in the first $176,000, you're paying FICA on wages, right? So money that you earn through wages. 6.2 for Social Security, 1.45 for Medicare. After you hit that wage base, 176,100 in 2025, you don't pay any more money and tax on the Social Security side, but Medicare is uncapped. So you continue to pay that 145 above there. But if your earned wages, just like on that NIT above, get over 125 as a married couple, then you pay an additional 0.9% on what's known as a Medicare surcharge. Again, part of the Affordable Care Act to help subsidize other people's insurance, right? The good news, though, is if you're self-employed, you don't get surcharge on the individual and the employer side, just one. So you do get a little bit of a break there. So this brings us to the summation of all of the different tax brackets: ordinary income, long-term capital gains or qualified dividends, Social Security, IRMAA, and again, we just did Part D, NIT income, and FICA for self-employed or employees, right? And you can see this gets pretty confusing. So to help you out, I want to give you a copy of this chart here. So as we conclude, if you're still with me, do me a favor, please hit the like button and consider subscribing. It helps spread this information to others who might need it. And more importantly, you'll be notified of future episodes. Today, we talked about the 5, really potentially 6 different tax brackets that a retiree might find themselves in from an income perspective. Now, ideally, taxes should be done in consideration with an overall plan and your investments and your income needs and so on and so forth. I understand how confusing and complicated it can be. So if you have any questions, please feel free to put them in the comments below or send an email to mike@truewealth.show. But for today, a good micro action might be to get the guide that's called Navigating the Maze of Retirement Tax Income. The way you can get that is to go to truewealthretire.com/tax-guide. There's a link in the show notes below. You can simply go to that page, scroll down, fill out the form, providing your first name and your email address, and you will get an email back. You confirm it, and bam, that guide is there. And it'll have a couple things in there for you. It'll give you a little description of all the different kind of brackets and incomes and sources of incomes we talked about. It'll give you the important numbers for 2025. So all the important threshold numbers in terms of tax and contributions, Social Security, a whole bunch of things in there. You'll get that. Plus, you'll get that AGI, MAGI sheet of what's included, to include the numbers here for both married and single folks in terms of the brackets. Remember, as a retiree, you have a lot of control of your income, which means you have a lot of control over the tax that you pay. The difficult piece, though, is navigating all of these different brackets and sources of income. So hopefully you have a better understanding of how taxes work in retirement. And more importantly, I hope this helps you on your path to retirement that is prosperous, enjoyable, and purposeful. Till next time, hope you have a great day. God bless you.